Hello guys, welcome to the discussion about IFRS 15 revenue from contracts with customers. This is relatively a new accounting standard. Therefore, it's very important to understand all the basic point of this accounting standard. The main page of this accounting standard is the five-step model. That is, this standard has introduced a model called five-step model in order to give a proper guidance on how to recognize revenue in the business. Let's first try to understand what is the five-step model. Under this five-step model, there are five steps that we need to follow in order to recognize the revenue for business purposes. So the first step is to identify the contract with customers. Under the five-step model, the first step is to identify the contract with the customers. As you may already know, in business operation, we are entering into contract with our customers in order to earn our revenue. Please understand here, the contract need not to be in writing. It may be a verbal contract, it may be an implied contract. Whatever the form of the contract, we have to identify the contract first. That is the first step in the revenue recognition in line with IFRS 15. Let's move to the second step. It is to identify the performance obligation. Here, performance obligation is what seller is supposed to perform under the contract. As you know, under a contract, there are duties on the seller. So we have to identify what are those duties that the seller have acknowledged in order to obtain his consideration. Okay. So having identified the performance obligation, then we are moving to the third step. Under the third step, it's necessary to determine the transaction price. Here, transaction price is the price that the seller is going to get in return for the performance obligation he is going to fulfill. Having determined the transaction price, we are moving to step number 4. Under step number 4, we need to allocate the transaction price among performance obligation. This is also a very important part of this five-step model, and we'll try to understand this part with some example as well. The final step is to recognize revenue when performance obligations are satisfied. That means under this model, we are recognizing revenue in our accounts only if performance obligations are satisfied. Therefore, we have to identify the performance obligation in the contract. Then we have to determine the transaction price. Then we have to combine these two and allocate the transaction price among the performance obligation, and ultimately we are recognizing revenue up to the extent of the satisfaction of our performance obligation. So let's try to understand this process with a simple example. Company X entered into a contract with the customer on 1st January 2020 to supply 100 computers and maintenance service for a period of 2 years from the date of the contract. Here, date of the contract is 1st January 2020. The customer agreed to pay currency unit 1.2 million for computers and the service, and he made the full payment on 1st January 2020. That means the customer has made the payment on the date of the contract. The computers were supplied to the customer on 1st January 2020. Other information is as follows. Okay, here this is a very simple scenario. Our company is Company X. Our company has entered into a contract with one of the customer. As per the contract, our company is supposed to supply 100 computers to the customer. Not only that, we are obliged to provide a maintenance service for a period of 2 years. For this total service and products, we are going to charge currency unit 1.2 million from the customer. On the other hand, the customer has made the payment on the date of the contract. These are the facts in the given scenario. Based on these facts, we have to proceed. So in addition to these facts, they have provided some sort of other information as well. What are the other information? The standalone selling price of 100 computers is currency unit 1 million. The second information is the company can sell a similar type of maintenance service in the market for currency unit 250,000 per year. Please focus on the terms. Okay, what is mean by this? Basically, if we sell the 100 computers along in the marketplace, we could have charged around 100,000. Oh, sorry, we could have charged around 1 million. We could have charged around 1 million. At the same time, if we sell the similar type of maintenance service in the marketplace, we could have charged 250,000 per year. These are the things they have provided to us. Based on this information, we need to determine how the revenue is recognized in accounts. Okay. Now, this is the scenario. Here is our company and this is the customer. Company and the customer have entered into a contract. Under this contract, these terms and conditions have been mentioned, and we have to perform 5-step model based on the given terms and conditions available within the contract. Okay, let's try to apply 5-step model to given scenario. Okay, first step is to identify the contract. In this scenario, the contract was entered into supply 100 computers and 2 years of maintenance service. Basically, our company X has entered into the contract in order to supply what 100 computers and 2 years of maintenance service. This is the contract. For that, we are going to get something. Currency unit 1.2 million. Okay, having identified the contract, we are moving to the second step, which is to identify the performance obligation. First, we are evaluating the contract, and based on our knowledge about the contract, we have to identify the performance obligation. So, performance obligations are the promises that the seller has acknowledged to perform under the contract. In other words, the seller is obliged to deliver these promises. What are the promises that the seller is obliged to deliver in this given scenario? The first one, to supply 100 computers. As the seller, our company is obliged to supply 100 computers. At the same time, the company is obliged to provide maintenance service for 2 years. These are the promises that the seller is supposed to deliver under our contract. Okay, so this is a very important step. Under this step, we have to identify the performance obligation. Without identify the performance obligation, we can't move forward. Having identified the performance obligations, we can move to the step number 3, determine the transaction price. How we are going to determine the transaction price? As per the given information, transaction price is currency unit 1.2 million. That means our customer has agreed to pay 1.2 million for satisfying these two performance obligations. What customer has agreed to pay is the transaction price. In this given scenario, it is very straightforward. The agreed price by the customer is 1.2 million. So we have determined the transaction price for this scenario as 1.2 million. Having determined the transaction price, let's move to the next step, allocation of the transaction price among performance obligation. Now we have identified the performance obligation. We have determined the transaction price. Now we have to allocate this transaction price among these two performance obligations. How we are going to perform this allocation? That is a very important part. The allocation of the transaction price among the performance obligations is performed based on the stand-alone selling price of each performance obligation. Please understand that part. We are allocating the transaction price among the performance obligation based on the standalone selling price. In simple meaning, standalone selling price means the price that we can derive from the market by selling each performance obligation individually within the marketplace. In our scenario, the standalone selling price for each performance obligation has been provided. So there is no issue for us. Now we can easily calculate the allocation of transaction price. How? Now, in this given table, you can see there are three columns: performance obligation, standalone selling price, and allocation of transaction price. Okay. Now we have listed our two performance obligation. The first one is to supply 100 computers, and the second one is to provide maintenance service for a period of 2 years. Please focus on the word very carefully. Now, from the given scenario, I have extracted the standalone selling price of each performance obligation. Supplying 100 computers is worth 1 million in the marketplace. On the other hand, we could have charged 250,000 by providing a similar maintenance service in the marketplace. Under the contract, we have undertaken to provide the similar service for a period of 2 years. So I have taken the standalone selling price as 500,000. How? 250,000 per year multiplied by 2 years. Accordingly, the standalone selling price of the provision of maintenance service is 500,000 for 2 year period. Now, this is the essence. Now we are going to offer our customer a package of product which is worth of 1.5 million. If we have sold these products separately in the marketplace, we could have charged 1.5 million. So the total of standalone selling price need to be determined. In this scenario, 1 million plus 500,000, it is 1.5 million, which is the total of standalone selling price of each performance obligation. Now we have to allocate this standalone selling price between our performance obligation. How we are going to allocate it? Here 1.2 million is the transaction price. Actually, we are offering our customer a package worth of 1.5 million at a price of 1.2 million. Please understand it. The standalone selling price of each performance obligation is 1.5 million, the total of the standalone selling price. But we are offering it to our customer at a price of 1.2 million, which indicates that we have allowed a discount to our customer. Therefore, we can easily calculate the transaction price in this way, allocation in this way. 1.2 million is the transaction price. In this transaction price, the supplying of computer indicates a relative significance in this way. How I have calculated the relative significance of this performance obligation within this product package. The standalone selling price of the 100 computers is 1 million, and this is included in a package worth of 1.5 million. Accordingly, this performance obligation is relatively significant in this contract, this much, 1 million divided by 1.5 million. So this is how we are calculating the allocation. 1.2 million is the transaction price. It is multiplied by the proportion applicable to each performance obligation under the contract. So based on our computation, the transaction price allocated to the 100 computer is 800,000. In the same way, we can allocate the transaction price for the maintenance service. The total transaction price is 1.2 million. At the same time, in a package of product worth of 1.5 million, 500,000 is applicable to maintenance service. Therefore, we can calculate the allocation in this way: 1.2 million multiplied by the relative significance of the provision of maintenance within this contract. So the relative significance has been computed in this way: 500,000 divided by 1.5 million. This is how we are calculating the allocation of transaction price. This is very important. Why? Only when we are fulfilling each performance obligation, we are recognizing revenue. Okay. Therefore, it's very important to allocate the transaction price to each of the performance obligation accurately, because the revenue recognition is completely dependent upon the allocation of the transaction price. If we have incorrectly allocated the transaction price, our revenue recognition would have mistakenly reported. Okay, so let's try to understand how we are going to recognize revenue with the final step in our 5-step model. That is step number 5, recognize revenue when performance obligations are satisfied. As described above, there are 2 performance obligations associated with this contract. The customer has made the payment on 1st January 2022. Okay, now I am going to illustrate you how we are going to record this transaction. Now, based on the given scenario, the customer has made the full payment, that is 1.2 million on 1st January 2022. That is on the date we have entered into the contract with the customer. So how we are going to account for this? That is the thing you need to understand first. Since no performance obligation has been fulfilled at the time of receiving payment, it is accounted in the following way. When the customer is paying us the full payment, we haven't fulfilled any performance obligation. Therefore, how can we account for it? We need the cash account in order to record the cash transaction. At the same time, we are taking an advance received account. If we are getting any payment from our customer without fulfilling any of the performance obligations, then we have to recognize that cash receipt as a liability. Since we are getting cash, we are debiting our cash account by 1.2 million. But we haven't fulfilled any performance obligation associated with this cash receipt. Therefore, I am recognizing this cash receipt as a liability. So I am crediting it to a advance received liability account. This is the first entry that I need to pass in relation to the payment received from the customer. Okay, cash account is debited, whereas advance received account is credited. Now what happens? On 1st January 2020, the computers were handed over to the customer. Accordingly, the performance obligation to deliver computers was fulfilled. Accordingly, this is accounted in the following way. Now, once we received the cash from our customer, we have handed over 100 computers to the customer. You can remember, handing over 100 computers to the customer is one of our performance obligations. Once we delivered 100 computers to the customer, one of our performance obligation has been fulfilled. Therefore, we can recognize revenue associated with that performance obligation in our accounts. How can we recognize it? Now, as per our previous accounting records, there is a 1.2 million advance received in our advance received account. This is a liability until we are satisfying each of the performance obligation. Now, on 1st January 2020, we have supplied 100 computers to our customer. Therefore, we have fulfilled one performance obligation. Therefore, we are entitled to recognize the revenue allocated to that performance obligation. If you can remember, out of the total transaction price, we have allocated 1 million to our first performance obligation, which is to supply 100 computers. So how we are going to account for that? Since my liability is getting reduced due to the fulfillment of the performance obligation, I am debiting the advance received account by 800,000. 800,000 is the amount allocated to the performance obligation. Okay, so it is not 1 million, it is 800,000 out of 1.2 million. 800,000 has been allocated to the first performance obligation, which is to supply computers. Accordingly, my liability account is debited by 800,000, and now I am entitled to recognize revenue in respect of this performance obligation. So I am crediting sales income account by 800,000. So the double entry is advance received account is debited by 800,000, whereas sales income account is credited by 800,000. This is how we are recognizing revenue when we fulfill performance obligation. Okay, please understand, in case of goods, we are recognizing revenue at a point in time. It should be noted that revenue associated with the delivery of goods is recognized at a point in time. At the point when we are delivering the goods to the customer, we are entitled to recognize the revenue. Okay, having recognized the revenue for delivery of goods, then we are moving to the next part. The revenue associated with the provision of maintenance service is recognized over the time. It's a service. Please understand, revenue associated with service are recognized over the time. Accordingly, by the end of 2020, half of the performance obligation has been fulfilled. Therefore, 50% of the revenue allocated to this performance obligation is recognized. Please understand, the second performance obligation, which is to provide maintenance service for a period of 2 years, is purely a service. In case of service, the revenue is recognized over the time. As per the given scenario, we have acknowledged to provide the service for a period of 2 years. Accordingly, by the end of 2020, which is the first year of the service arrangement, we have completed 50% of the performance obligation. So we are entitled to recognize the revenue up to that part. How we are going to recognize the revenue? Now this is the status of our advance received account. We have received 1.2 million. Out of that, 800,000 has been recognized as sales income. Okay. Now, in addition to that, we can recognize the revenue in respect of the provision of maintenance service up to the point that we have completed. How we are going to recognize it? For that, we are taking an account called service income. How we are going to recognize the revenue? We are debiting the revenue. So we are debiting the advance received account by 200,000, which is the revenue associated with the first year maintenance service, and we are crediting the service income account. Here we have allocated 400,000 for what? We have allocated 400,000 for our provision of maintenance service. Out of the provision of maintenance service, 50% has been fulfilled. Therefore, out of 400,000, we are taking 200,000 for the first year income. Therefore, I am debiting advance received account. At the same time, I am crediting service income account. This is the double entry when we fulfill the service arrangement. Okay. So at the end of the year, you can tally this account, and there is a carried down balance of 200,000. This balance can be shown under the statement of financial position as a current liability. Okay, let's move to the final year. By the end of 2021, the remaining part of the performance obligation related to the provisions of service has been fulfilled. Therefore, revenue can be recognized for year 2021 in the following way. Now, in the 2021 as well, we are providing service to our customer. For that, we have to recognize the revenue by the end of that year. How we are going to recognize the revenue? Now, in our advance received account, there is a brought forward balance of 200,000. This is the amount that we have received in advance from our customer for providing service for the year 2021. At the end of the year 2021, we have completed the provision of our service. Accordingly, we have fulfilled the performance obligation. So we can recognize the revenue for the performance obligation in year 2021 in this way. How? We are debiting the advance received account and we are crediting the service income account. In this way, we can recognize revenue for year 2021. Okay, so this is a very simple example where you can understand the basics of SLFRS 15. Before concluding our session, I would like to summarize what we have discussed. Basically, IFRS 15 introduced a 5-step model. Under this 5-step model, we have to follow 5 steps in order to recognize the revenue. First, we need to identify the contract. Then we need to identify the performance obligations under the contract. Then we need to determine the transaction price. And having determined the transaction price, we have to allocate the transaction price among the performance obligation. It is very important. And at the final stage, we are recognizing the revenue based on the fulfillment of the performance obligation. This is the basic part of the IFRS 15 discussion. So it's very important to understand this basic. Without this basic, you can't proceed further under IFRS 15. Okay, I hope you have enjoyed our session, and for future videos, please subscribe that. In future, we are going to discuss more and more. Therefore, please subscribe us and join with us.